Hello, finance students. Just first, let me say, man, I miss you guys. I wish we could finish this year together. I was really hoping they would give us the last couple weeks together at school. I'm sorry it didn't work out that way. I know that disappoints you. It definitely disappoints me too. Man, I'm just sorry that it went that way. But you know what? This is a blimp, just a little blip in your radar. Okay, you got a whole life ahead of you, and I guarantee someday when you hold your newborn baby in your arms, you're not going to look back and say, man, I just wish I could have had my last 2 weeks of high school. You're not going to care. You're going to only care about that newborn baby and your new family. So, this is just a piece of your life right now. You got much bigger things coming. I just wanted to say that to you guys because I really think that is true. So, I also wanted to cover number 5 on this worksheet. It's a situation that you guys haven't ran into. It's addressing arm loans. All right. So looking at number 5 here, you got current national mortgage average is right around 4%. It's 4.2%. And let's say a bank offers you a 2.8% interest rate. Well, the first thing I want you doing when something like this sounds too good to be true, I want you to be cynical about it. And I want you to say to yourself, wait a minute, what's the catch? I hope you are like that when it comes to finance. If something sounds too good to be true, it is. Not it might be, it is. That's the golden rule for finance that you need to approach, or I'm sorry, you need to think about things when somebody approaches you with something like this. All right, so this sounds too good to be true, and it is. All right, an ARM loan stands for adjustable rate mortgage. That's what that stands for. So that means this. That means the bank can adjust your rate on this mortgage. Okay, and they are allowed to adjust it by up to 2% every 2 years. That's huge. And let me show you what the numbers look like real quick. All right, so let's say you could afford this house and you took out a $150,000 loan on this house. So maybe it's like a $180,000 house. You put 30 grand down. Okay. And you went ahead and signed up for this ARM loan because you wanted the better interest rate. All right, so here's what it would look like. 150 grand at 2.8% for 20 years, your payments right here. So this fits. You can afford this, let's say. Let's say this fits in your budget. But you signed up for an adjustable rate mortgage. That's why you got this. They call this a teaser rate. Okay, that's what this is really called in the finance industry. We call this a teaser rate. Okay, they gave you this nice little teaser rate, but then they're going to adjust it and smack you in the face. All right, so let's take this same $150,000 home and let's have it adjust. All right, let's have it adjust. I don't know, just a little over around 1.5%, let's say. So this thing jumps up to 4.3%. Well, watch what happens to your payment. It used to be $816 a month. Now it's $932 a month. And guess what can happen again 2 years later? Yeah, that's right. It can adjust again. And it's going to adjust up. The bank's not going to be like, you know what? Let's pass on savings to our customers. I mean, the bank's out to make money. They're a business. So they're going to adjust it up. So let's say this adjusts to 6% a couple years later. Now your payment is over $1,000 a month. You could afford the 816, but the question is, can you now afford the 1,074? If you can't, you're going to lose your house. That's why this is a bad idea. Never, ever in your life should you sign up for an adjustable rate loan. And any of you who are thinking about student loans next year, if you go through Sally Mae actually has adjustable rate loans. Do you remember we talked about the private industry, Sally Mae? They offer adjustable rate loans. Don't take those. Get the fixed rate every time because they're going to adjust up, not down. So you need to say no to every adjustable rate that you're ever offered in your life. It's just not a way to protect yourself. It's actually a way the bank protects themselves from rising interest rates. They can adjust yours up when the interest rate goes up. Okay. So horrible idea to ever get an adjustable rate loan. Just wanted to pass that on to you. You can go ahead and complete the worksheet. I would suggest doing 1 through 5 today, doing 6 through 8 tomorrow. All right. Take care. God bless you and your family.